Welcome back, guys, to another Zero DTE video, and today Ernie's going to be talking about unexpected markets, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy, guys.
You don't want to be sitting here thinking that there's got to be an answer, that I need to figure this out or all that, because it is virtually unknowable at any point of time, whether it's over the weekend, in the morning, in the afternoon, or in the evening. You just don't know. And even if you did know, you would be too late to the party by knowing these things. So that's why it's best to take it all in and understand what it really is. And it is a casino. It is a random maelstrom of potential of what could happen, up, down, whatever. And that the only way that you can effectively capture any kind of alpha or edge is to be ahead of the move, whatever move might be there or might not be there. And you don't know how big that move's going to be, when it's going to come, and what direction it's going to go in. Now, from directionality, yes, there are some patterns in the randomness. When we're trending, there is a pattern in that randomness that the moves in the direction of the trend tend to be a little bit bigger on average than the moves against it, and regardless of whether it's a bull or a bear market, but still it's about a 50-50 shot. And also the magnitude of those moves. There may be some pattern to the magnitude or the sequence of moves. That's much more difficult to discern because that sequence is both size and temporal in nature. And the temporal part is the tough part. Is it going to be a sequence of 2, 3, 4, 5 things? And what's the sequence going to be? Small, medium, large, small, large, small, large, small, large. You don't know. But all that resolves down to this sort of distribution that the vast majority of the moves are small. A smaller minority of the moves are medium. And a much smaller minority of the moves are these outliers. So we got these things. How do you take advantage of them? The simple answer would be that you need to take as little risk as you possibly can, because if you're going to have to be in the market every day to try to capture these moves, you can't afford to put a lot out there. And particularly with the knowledge that you're kind of a 50-50 player here in taking these shots. So you have to devise your strategy in such a way that by being in the market all the time and having the ability to take advantage of this plethora of moves, this distribution of moves that is like this bell curve in a very regular thing. It has to be asymmetric. You need to have small loss you can define and that you can live with even under the worst of cases, and a wide net ability to be able to capture anything that is thrown your way, whether it's a small move, medium move, or a big move, right? That's our only logical adjustments to that strategy that will vary our exposure to that risk. We have a number of things that we can do. We can change our overall asymmetry. We can change in that asymmetry what exactly the parameters of that are, our risk to reward. We can change the temporal nature of what we do and the magnitude of the risk that we put out there. Those are like the 3 dimensions that we have control over. We find edge by understanding that asymmetry, that temporal nature, that timing, the expansion and contraction of available alpha or edge that's out there. Those are other things that we know, like when there's high volatility, everything opens up and we can open up and be more open to much larger potential and lesser temporal nature. In other words, short time frames don't bother us and we can take advantage of that. In lower volatility, it's exact opposite. We have to contract in terms of our overall exposure to risk. And what we're finding now, and this is what we're getting to, what I'm getting to, is this. We've done it in the past, but not to this extreme because we haven't met a market quite like this. But we have to expand our temporal nature to it too. It seems that now the market has gone to such low levels of volatility that the acceleration of premium, which is one of our primary edges, has accelerated even faster. In other words, the amount of premium that's available on that 0 DTE, even that 1 DTE, is so less that it's hard to grab that extra edge. And the edge of price movement has diminished as well. So it's hard to grab that. So we have to manufacture or adjust both the asymmetry and the temporal nature, the length of time that it's applied, in order to effectively grab those things that we're missing.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.